So, um, it is still the same stuff. I'm sure you saw when in the video, you saw the section where we talk about um spotting out relevant swing points, right?
Yes.
And why the swing point should be relevant. So it is the same thing I taught to you before I gave you the course. The same stuff, allowing it to collect a swing to make it
Yes.
relevant, and then you anticipate it to make it you anticipate the next push. But what is in the course that is a little bit advanced and different is that with that particular video or with that particular stuff in the course, you are able to tell without a trend line where this particular leg is going to stop or where this particular higher low is going to start creating. You're going to tell. And you'll be able to tell because of the impact of the smart money knowledge that have been put into the Falcon strategy for our own course. All right. So basically, for the Falcon strategy, what we have here currently is that we have a high and then we have a higher high. And this high became relevant. Why? Because price collected a significant pullback here. That is why this high became relevant. And then when it came back down, we went back up again and then to break through and created a higher high. This high became relevant
Mm.
when price collected this internal structure. That's how this high became relevant. And from based on trend line, we are going to put one and two touches, and then we'll be anticipating something like this. This is what I taught you earlier, right? So this is the basics. Just identifying which of the swing point is current and then is relevant and why they are relevant. Said, if you are marking out the current swing highs and based on the trend for here we are marking out current swing highs, and this became a swing high and valid because it collected this low. This became a swing high and valid because it collected this low, right? Now, for we to be able to anticipate this
Okay.
particular one, if you are sticking strictly with the Falcon strategy, it have to start pushing out before you are able to predict the second touch. You are not able to predict second touches with the Falcon strategy alone. You can only predict third touch. So if you are trading just the Falcon strategy, you are likely not going to take a trade here because you have to let it start, pushing up. Or if you take a trade, you're likely going to crash before, just like this particular cycle,
Okay.
one and
Okay.
two. If you take a trade here, it might go and then crash you because you're not really sure if it's going to pull out. But with that course I gave to you, with the explanation I did in the course, we implemented smart money concept knowledge. And then with that, we are able to detect where the second touches are likely to happen, right? And that is why you see in the course, we spoke about break of structures, which we just try to identify that, yeah, this is a break of structure to the upside. And since price broke structure, we look
Right.
for significant um, supply and demand levels that price is supposed to, come back to before continuing the trend. Now, we are looking for buy, so you're looking for demand. And our demand levels on this particular impulse, this particular push, we are paying attention to all of these pullbacks. Then we look for one that is non-mitigated and use it as a clear demand. All right. So that if price comes to interact with that demand, which is not mitigated, then we can start to actually pay attention to the buys to continue the trend from the second touch. And also, if we continue the trend from the second touch and price comes to our trend line third touch, which is the Falcon primary way of trading. When price comes to third touch like so, we know that yes, it is also an opportunity time because this is what we always look for Falcon, the third touch, so that you can capitalize on that particular move, right? So if you combine the
Right.
two systems, you are able to capitalize more on price compared to trading one of it. And you're not actually combining the whole
Mm.
concept. You're just picking the important ones from the smart money to attach to the Falcon so that you can be able to capitalize more. So based on that knowledge, if I am to look at this particular impulse, I need to look for a clear demand because we are breaking up, right? I need to look for a clear demand that is good enough to hold price back to, interact with our swing high. Now, if you're only trading Falcon
Right.
blindly, you would have, marked out this. And maybe when this guy pushed up, this pin bar happened, engulfing this one, you would have want to do this here. And then you would have wanting to buy here, something like that. Maybe after this engulfing bar, you'd have wanting to buy here because, yeah, it's actually pushing off that. And then you see your trading position a little and then it came back against you, right? Because you are trading just price pattern. The second thought is always impossible for you to mark out unless you are using the structure within. So if you now combine it with the supply and demand, your focus is going to be here because price have to come back to retest something here before continuation. Now, I don't know if you were trading or if you remember when, I don't know if you, had that process, but there were times when we were coming into the industry, we used to trade support and resistance. Somehow, the whole trading system still happens within support and resistance. So supply and demand is kind of like support and resistance, but it's a little bit advanced. So price push up significantly, like this is an impulse that broke this previous swing. Now we have to pay attention to this impulse and read into it. We need to look for a relevant demand zone to buy price from. All right. We need to look for a relevant demand zone to buy price from. Now, before you find a demand zone, the things you have to understand is if you use the fib, you can pull up the fib from the the last end to the highest level before we started the drop down. Then you look for anything below this one. Anything below zero point 0.5 that is not mitigated is what you are going to buy from because this is a discount price and this is a premium price. So we will not be buying from high levels. When they say they give us the talk about price, buy low and sell high. This is the concept that is used to actually, decipher that advice of buy low and say high. So anything above zero point 0.5 to here is high. So we cannot be buying here. Anything zero point 0.5 to this is low. So we are looking for a point of interest that is relevant here that we can buy and continue the price. All right. So now
Right.
if you look at the episode one and episode two of the course, it spoke about how to decipher a relevant order block and then what is another block. Don't know if you remember that.
Yes.
All right.
Yes.
So
I
based on
remember.
those, yeah, based on the criteria to decipher those relevant zone, we have to now pay attention to what we are having. For me, I'm going to be showing you order flow. So from here is the last level. We have this push up, price came back down. We have this push, price came back down. Then we have this push out of it before we had this little battle here. This kind of like accumulation here. Then we have this push, price came back down. All right. Then we have this push, price came back down. We have this push, price came back down before the final impulse. All right. Now, since we are saying that
Yes.
we are looking for stuff that are below 50, that is where we are going to be looking for our demand zone from, right? And this is the 50 mark. So we are looking for anything within
Right.
here that has not been mitigated. When I say mitigate, it means price have not come back to interact with it after creating that retracement. Now we are buying, right? And
Mm-hmm.
this was the first retracement here. This retracement, this guy came back to fill it, so it is no longer valid. We now shift our focus to this particular one that filled the first one. Price push up, you can see that price came back a little, but it is yet to fill this particular retracement. So we have this retracement that is left unfilled from here to here. So this from here to here, you can see prices, all the pullback we have, prices didn't come back to it, right? Now we move to the next one in case we can find another one within the 50 mark. So we see that here to here, we push up here to here. You can see that this particular push down was interacted by this one, right?
Yes.
All right. So it was interacted. So that particular level is no longer considered to be a demand level anymore. And then this particular one that came down is kind of like on the 50 mark. So it is 50-50. We used to call this one decisional point of interest. It's decisional. So it might not happen. You understand? So we also have this one here. Obviously, price failed it, so we are not going to pay attention to it. We're not going to pay attention to it. Then the next thing is this
Mm.
particular one. This is the one we are paying attention to, and this is where price have been reacting from currently. This is the um extreme point of interest. It's an extreme point, right? So when price comes to interact with the extreme point of interest, then we know that we are now on that particular we're having that probability of having our second touch on this particular trend line. All right. We're having that probability of having our second touch on the second trend line. Then when we buy price, we are taking price to here, and then the final touch will be on our trend line because we are using Falcon as directional bias. All right, because we know Falcon move from pattern to pattern, from trend line to trend line. So when
Okay.
price comes here, what we do is to go to the lower time frame. But I will not be going to the lower time frame in this video with you yet because I want you to be able to identify the demand and then the supply. Then I want you to be able to identify just the structure mapping like this is what you are going to I'll be doing with you for now. Then when we are done here, we'll go to the lower time frame because that is where you get to filter the entry before actually executing the trade. There are criteria to be met even if price come into your demand and supply level. There are criteria to be met on the lower time frame before you actually trigger the price. All right. So we will not go there.
Okay.
I'm just going to give us more scenarios because this is exactly what you're going through in the course. This is exactly what's in the course. So if you're able to master this, that's all. The demand.
So with the order block in this instance, we taking that whole
Yeah, we're taking this whole. We're
area
taking it
now.
because this is not an order block. This is an order flow. There's order block and then there's
Okay.
order flow. All
There
right.
is order
Now,
flow.
order
Right.
flow is kind of like a retracement in a particular, when we have a
Right.
particular move, a particular impulse, those retracement, they are called the order flow. Price have to come back into those retracement to be able to gather momentum to continue the trend. That is what an order flow do. And it is also called the
But
demand.
can you still have an order block within this order flow?
Yeah, it's possible. Just like this one, there's an order block within this particular order flow. Here, this is an order block
Right.
candle. This one, this green candle. And it meets all of the criteria because it took the previous candle low. You see, it is lower than the previous candle. This is the
Right.
order block criteria now. I'm sure you remember from the course. It
It's
took the
lower
previous
than
candle
the
low,
previous candle,
exactly,
and
and then it has
that
imbalance
candle did not touch
mitigate. That's right. That is the imbalance. So it
mitigate.
has
Yeah.
imbalance there. So this is an order block
Yeah.
candle. So if you want to use the
Okay.
order block candle, you can also use the order block candle. But order flow has high probability compared to the order block. There. This is where I bring the order block. Price now
Okay.
have collected the
Okay.
whole order block. And also this one is price collecting the whole order block is normal because you know market is always looking for liquidity. There are traders who also trigger trade directly from the order block like this and put their stop loss below. So this is kind of like
Mm.
it's called SMT, which is smart money trap, because smart money are the one that trade the order blocks and supply and demand. So when price trigger like so and collect the order block, it means it's collecting smart money trap. That's why for me, I like to use the order flow. Personally, I use the order flow
Mm.
because when price come into that, that one is more um it's high probable. It have high probability. When price come into it, you have to look for the confirmation before you execute. Also, if you are using the order block, you have to also wait for the confirmation. But that is going to be something we will do next time. For now, we have to focus on helping you understand the structures and helping you understand the difference between order flow and order block, right? So this particular order flow, the only thing that can make it mitigated, you see this one, the order block. I'm glad you remember the criteria. The third candle shouldn't mitigate it, right? The second candle after it
Yeah.
shouldn't mitigate it.
Right.
It's same thing with the order flow.
Mm.
The order flow, there should be no retracement that come back into it. It should also have imbalance. You see, this is where the order flow stopped from here to down. This is where it started from the top here down. And before the other retracement,
Okay.
there's also an imbalance there. There's an imbalance. This candle came out of
Yes.
it. So there was no other candle that came back into the order flow. So it is a valid one. It is not valid. It is not mitigated. But for the case of this other one, this one here, you can see we have the accumulation here, the order flow here, from here to here.
Mm.
If I extend this one, you can see this particular, after price push out, it came back right into it. It means
Came
this
back
order
to
flow
it.
is mitigated and
Right.
it's no longer useful.
Okay.
Yeah. It means it's
Okay.
mitigated, it's
I
no
see.
longer useful. So the criteria to identify the order flow is kind of like the criteria to identify the order block. But the difference between this one is that you don't need to be lower than any other candle. You know, the order block, you have to be lower than the previous candle before it. That one doesn't matter for the order flow. The order flow, the only criteria is that it shouldn't be mitigated. And then it should sponsor the break of structure as well. So it shouldn't be mitigated. And then it should be within the 50 down. That is if you're looking for buys. If you're looking for sales, you should be at the top side, at the premium level. You want to sell from a high level. So you should be. So that is basically
Yeah.
how you read the direction as well. And you predict the second touch of your trend line. You know that this is an order flow. When price come into it and start giving you the bullish vibe, you know that it is time for the second turn. So you're just using the trend line for a directional confluence because you can also trade this structure without the trend line. You can just know that this is a break of structure to the upside. And then you know that once it's pulling back, it
Mm.
is coming to meet any of these institutional levels. And then when you go on the lower time frame, I'll show you the confirmations. If you said you have covered from episode 1 to 3, so all of those things are also
Yeah.
covered in those episode 1 to 3. I spoke about the internal structures, how you can also leverage, on this particular internal structures, how you can trade it from the lower time frame to meet your point of interest here on the 4 hour. This is the 4 hour time frame. So if I was back,
Okay.
we're back there, there are reasons, there are, ways to capitalize on all of this down to this level, and then all of that is on the lower time frame.
Okay.
So the trend line, you just use it as confluence and also maybe as target and reason to kind of like hold on to your trade. If you after get, let's say we get confirmation here and then we have aligned our trend line, we see that we are having this particular structure based on the Falcon system. You have your first target here, and then obviously you have your second target or the final target on the trend line. So you can also work like that.
Okay.